Happy Friday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. I'm still here on my vacation in Bali. As such, I'm filming in my hotel room. Please forgive the informality of the setting. This will be the environment in which these episodes are filmed until at least midway through next week. Now we have a lot to get through, so let's jump in. And first up, the US economy shrank for the first quarter of 2025, marking its first contraction since 2022 and delivering an early, sobering verdict on US President Donald Trump's sweeping new trade policies, though the White House has always maintained that short-term pain was always going to be a reality. Data released Wednesday by the Bureau of Economic Analysis showed that inflation-adjusted gross domestic product, GDP, declined at an annualized rate of 0.3%, well below the 3% average growth recorded over the past 2 years. The downturn was driven largely by a historic surge in imports as companies scrambled to stock up ahead of Trump's impending tariffs, along with a pullback in federal spending and more tempered consumer activity. Net exports subtracted nearly 5 percentage points from GDP, the largest drag on growth, as imports soared by 41.3% on an annualized basis, the fastest rate in nearly 5 years. Despite the contraction, some components of the economy held up. Consumer spending, which makes up roughly two-thirds of GDP, rose at a modest 1.8% pace, its weakest since mid-2023, but still better than many analysts had feared. Business investment in equipment grew by a striking 22.5%, powered in part by a post-strike surge in commercial aircraft production and increased spending on technology-related hardware. Trump's trade strategy, including a barrage of tariffs on Chinese and other foreign imports, is being felt across every layer of the economy. While many firms rush to bring in goods ahead of levy hikes, economists warn that this front-loading of imports will likely reverse in the second quarter, potentially creating a temporary boost in GDP. But the longer-term outlook remains clouded. Quote, corrosive uncertainty and higher taxes, tariffs are a tax on imports, will drag GDP growth back into the red by the end of the year, end quote, said Carl Weinberg, chief economist at High Frequency Economics. His forecast reflects growing concern among economists that the tariff-driven supply shock could constrain business operations, discourage exports, and weigh on consumer sentiment. Meanwhile, inflation appears to be stabilizing, at least for now. The Federal Reserve's preferred inflation gauge was flat in March, excluding food and energy, marking the softest reading in nearly 5 years. But the broader price environment remains volatile. A separate measure of underlying inflation rose to a 3.5% pace in Q1, its highest level in a year, highlighting the challenge facing monetary policymakers. The Fed has adopted a wait-and-see approach, signaling no rush to cut interest rates amid deep uncertainty about how tariffs will affect inflation and consumer behavior. Incredibly, the US effective tariff rate now stands at nearly 23%. The highest level in more than a century, according to US-based Bloomberg Economics. Although consumer spending held up in Q1, there are signs that households, especially those on lower incomes, are beginning to struggle. Confidence indicators have fallen sharply, and major retailers have warned of weaker discretionary spending and slowing big-ticket purchases. Trump has suggested that his tariff strategy will ultimately benefit middle-class Americans by enabling further tax cuts. Over the weekend, he floated the idea of reducing or even eliminating income taxes for people earning under $200,000 a year, paid for by increased tariff revenue, a claim that many economists are skeptical of. Financial markets reacted coolly to the GDP news. Trump, in a post on Truth Social, attributed recent market weakness to, quote, Biden-era inflation, end quote, and reiterated that his policies will take time to bear fruit. Yet polls suggest mounting public frustration. A CBS News survey released in recent days found that 69% of Americans feel the Trump administration isn't doing enough to lower prices. Approval of Trump's handling of the economy has dropped to 42%, down from 51% in March. At the same time, Trump remains committed to his economic agenda. He has vowed to extend the income tax cuts passed during his first term, many of which are set to expire in 2025, and proposes deeper reductions to corporate taxes and exemptions for workers' tips and social security income. On the fiscal side of things, federal government spending fell 1.4% in the first quarter, the first decline in over 2 years, largely due to an 8% cut in defense outlays. Trump's recent decision to temporarily pause military aid to Ukraine contributed to the drop. Whether that spending cut is a one-off or a sign of broader fiscal restraint remains to be seen. In the meantime, policymakers and markets alike are bracing for continued volatility in the months ahead. With economic growth now in reverse and recession risks rising, the second quarter will be pivotal in determining the trajectory of the US economy. Some rebound is expected as trade normalizes and inventory levels stabilize. However, the broader challenge remains. Can the Trump administration's high-tariff, low-tax vision deliver sustainable growth without inflicting too much damage along the way? As Wall Street strategist Dave Lutz put it, quote, "It was whiplash after whiplash after whiplash," end quote, during Trump's first 100 days, and that, it seems, may only be the beginning. In the last few months, we have seen so much happen already. The world is going through massive change. This trade reset is just part of it. We are very much living history. If you want to be on top of the most up-to-date financial and economic developments as our world goes through this tremendous change, make sure you're subscribed to Market Update, and you will be. And if you're getting some value from today's episode of Market Update, don't forget to hit the like button. Next up, the Bank of Japan has sharply downgraded its economic growth projections for 2025 and 2026, citing escalating global trade tensions and warning that its push to normalizing monetary policy is increasingly uncertain. In a quarterly update released alongside a decision to keep the overnight call rate steady at around 0.5%, the Bank of Japan cut its GDP growth forecast for 2025 from 1.1% to 0.5%. An over 50% reduction, and for 2026 from 1% to 0.7%. It also expects inflation to fall below its 2% target, reaching just 1.7% by 2026. Bank of Japan Governor Katsuo Ueda said at a press conference on Thursday that higher tariffs were a key driver of the economic downgrade. He warned that both inflation and wage growth could stagnate in the near term, making the outlook for further interest rate hikes increasingly uncertain. Quote, "There are extremely high uncertainties regarding the future course of trade and other policies in each jurisdiction and the impact of those policies on economic activity and prices at home and abroad," end quote, the Bank of Japan said in its Outlook report. Ueda added that the central bank's baseline scenario assumes some progress in trade negotiations and no major supply chain disruptions. Assumptions, he admitted, may prove too optimistic. The timing of the reversal is significant, as it coincides with a new round of US-Japan trade talks in Washington, where Tokyo is seeking to soften or avoid additional US tariff threats. Ueda acknowledged that even after tariffs are finalized, their economic impact will remain highly unpredictable. Although some economists had expected the Bank of Japan to make incremental rate hikes this year, Thursday's report suggests that underlying inflation will remain weak due to an expected economic slowdown. Still, the bank said it aims to raise rates over time if inflation and growth conditions allow, with a medium-term goal of meeting its 2% inflation target by fiscal year 2020. And finally for today, the United States and Ukraine have finalized a landmark economic agreement granting Washington privileged access to Ukraine's critical minerals and natural resources. The deal, which centers on a jointly managed, quote, reconstruction investment fund, end quote, comes amid rising tensions in US-Ukraine relations and uncertainty over President Donald Trump's efforts to broker a peace agreement with Russia. At the heart of the agreement is a new investment fund that will channel resources into the extraction and development of key Ukrainian assets, including aluminium, graphite, oil, and natural gas, as well as associated infrastructure and processing capabilities. Ukraine's first deputy prime minister emphasized that while Ukraine will retain control over what resources are extracted, both nations will co-manage the fund on equal footing. Importantly, all profits from these ventures will be reinvested in Ukraine during the first 10 years, with no provisions tying Ukraine to any debt obligations towards the US. The fund will also serve a dual purpose, accelerating Ukraine's economic recovery and reimbursing the US for future military and reconstruction assistance. Half of the revenues from newly licensed products will go into the fund, which will offer the US the first claim on profits as compensation for its support. The deal marks a significant pivot in bilateral ties after months of strain. Ukrainian President Zelensky had previously left Washington empty-handed in February following a public confrontation with Trump and Vice President J.D. Vance in the Oval Office. The tensions had sparked fears that Trump was preparing to scale back US support. However, the resources deal provides a critical political win and signals continued American engagement in Ukraine's post-war future. That is, of course, if an acceptable end to the war can be reached in the meantime. Quote, "This agreement signals clearly to Russia that the Trump administration is committed to a peace process centered on a free, sovereign, and prosperous Ukraine over the long term," end quote, said US Treasury Secretary Scott Bessent, adding, quote, "No state or person who financed or supplied the Russian war machine will be allowed to benefit from the reconstruction of Ukraine," end quote. Despite its economic significance, the agreement offers no formal US security guarantees. It also stops short of promising new weapons shipments, although Ukrainian officials say the deal reaffirms American commitment to Kiev's broader security and recovery. The Ukraine Prime Minister praised the deal as a victory, noting that the US ultimately dropped its insistence on repayment for past aid, a sticking point that had included demands of up to $500 billion from future rare earth revenues. For Ukraine, the deal signals a lifeline for its economy and a reassertion of US support, albeit under new terms that reflect a transactional Trump-era diplomacy. As peace remains elusive, the success of this partnership may ultimately determine the trajectory of not just US-Ukraine relations, but the conflict situation generally in the months to come. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. My vacation here in Bali will continue until midway through next week. As such, videos will remain infrequent and some normalcy should return by next week. In the meantime, thank you so much, everybody, for your patience with me. Thank you for watching today's episode. Have a good Friday, have a wonderful weekend, and I will see you for another episode of Market Update in a few days.